I've always been a fan of kind of planning for future me and not just, focusing on the needs of myself in the current day. And, just kind of fast forwarding from that point when I was 16, fast forwarding about 10 years from then, both my mother and my grandfather, who I mentioned, unfortunately had both passed away. And so what that did was they actually left me with their retirement accounts, with my sisters and I. Wasn't a life-changing amount of money, but I now had the retirement accounts of a baby boomer and a member of the greatest generation.
Welcome to the Apartment Guys, where we dive deep into all things multifamily investing. Our mission is to educate, inspire, and empower real estate investors to reach their highest potential. Each week, host Tate Seymour interviews high-level guests from all over the industry who are sure to bring valuable, actionable ideas that will propel your career to the next level. Whether you're just starting out or a seasoned investor, you are in the right place. And now your host, the Apartment Guy, Tate Seymour.
Welcome, everybody, back to another episode of the Apartment Guys podcast. And today we have Mr. Josh Plave on the show. We are blessed to have him. He's going to share with us lots of good knowledge about self-directed IRAs and really like that whole side of the apartment investing scene we get to delve into today with Josh. Josh is a multifamily syndicator who specializes in helping investors use their retirement funds to passively invest. Through his company, Wall to Main, Josh provides all the tips and tricks needed to invest quickly, safely, and inexpensively with an existing retirement account. Okay, so before I want to learn a little bit more about you, Josh, and kind of your background and everything, but let's just set this up. So as most of the listeners know, there's basically two ways to be involved in a multifamily syndication or a multifamily apartment deal. One is to be a general partner, or a sponsor is another way of another term for that position in the deal. And that is basically the operator of the deal. Usually they find the deal, source the deal, vet the deal, do the due diligence, and all the things that go along with the operation of the deal, both before closing and after closing. The other way to be involved is passively through investing capital in these deals. And that's what Josh helps people do with their retirement accounts. And basically, all of us are in this business and this space because we believe that this asset class, in particular, apartment buildings and multifamily commercial real estate assets, is really where it's at when it comes to so many different advantages, from cash flow to appreciation to tax advantages to risk mitigation, et cetera. There's so many advantages to being in this. And your IRA is a tool that you may have sitting in your lap right now, ready to rock and roll as a ticket into this industry, into this business, and away from the volatility of the stock market. So with that actualization, Josh, welcome to the show. I'm really stoked to get to hang out and jam with you today.
Thanks for having me, Tate. Appreciate it.
Yeah, you bet. So share with us a little bit about your background and kind of how you got into syndication in particular, and then how you got into helping people with IRA investing.
Yeah, absolutely. So I kind of like to blend both sides of that story together. So, I actually, if you're watching over a video, or if you can see that I'm, young, I'm 30 years old. If it's just over audio, yeah. A lot of people ask, why do you know so much about retirement accounts when you are so far? I'm halfway to retirement. So I actually opened up my first Roth IRA when I was 16 years old. My mother and my grandfather were both CPAs, and they sort of suggested that, I didn't have a lot of costs at the time. The small amount of money that I had earned that summer working, I should just kind of put it to use and start investing. So I started investing what I knew was, equities, stocks and bonds, things like that. And I just kind of started, understand the value of the compounding dollar from there. Mm-hmm. And so from there, I've been contributing to that account. I've always been a fan of kind of planning for future me and not just, focusing on the needs of myself in the current day. And, just kind of fast forwarding from that point when I was 16, fast forwarding about 10 years from then, both my mother and my grandfather, who I mentioned, unfortunately had both passed away. And so what that did was they actually left me with their retirement accounts, with my sisters and I. It wasn't a life-changing amount of money, but I now had the retirement accounts of a baby boomer and a member of the greatest generation. And I had to figure out what I was going to do, making sure I was honoring their legacy, taking care of everything that they had worked for their entire lives, and not just kind of blow it all on the first thing that came along that seemed really nice. And so I started, it was kind of at a time it's one of those moments, lose a family member, you start kind of having a reckoning, like, well, what am I doing with my life? What do I want to do? And so it was kind of a moment where I was shifting gears with my career. And so I kind of took a step back, started looking at real estate because I wanted to have more control, not just over my own financial future, but over the actual result of what, everything that I was doing day to day. I wanted to see tangible results from what I was working on, at my desk every day. And so I started sort of doing a self-taught curriculum, long story short, I ended up in multifamily as a result. But I ended up finding out how I was going to use those retirement accounts to invest in multifamily. I found that multifamily was one of the best possible investments for a retirement account, extremely stable, for all the reasons that you listed out earlier. It really matches well with a retirement account. And so I kind of figured out how to best align those. And then I went out and I started looking for properties that worked best for retirement accounts for my investors.
Awesome. So how long have you been doing this? How long have you been syndicating and looking for deals for your family's accounts and other people's accounts?
We're going on about 3.5, almost 4 years now.
Okay. That's about the same time I've been in this space. So it's been an exciting few years, quite a ride here through COVID and whatnot. But if anything, COVID seems to have accelerated the commercial multifamily activity and hype and everything else around it, amazingly. So let's back up for a sec. So you went out and you started looking for properties for the retirement accounts that you were entrusted with through unfortunate circumstances. Obviously, I'm very sorry for your loss.
Thanks.
What did you start looking for? Like, what was your mindset at that point?
It's interesting. There's the way I've seen it now that I've especially approached it from the operator standpoint. I really see two different types of approaches for retirement investors, and I found myself landing in one of them. There's the half, and it's the majority of people who, their retirement account isn't something that they need to or can touch for quite a while. If you take an early withdrawal, you pay penalty fees, you can take the money out, and most people don't want to touch the money for a while. And so you're not necessarily looking for the highest cash flowing deal. You're not looking for something that's completely 98% stabilized the whole way, ready to go and issuing distributions day one, because if you have cash flow, it sits in the account, and then you really can't make use of it. If you wanted to actually see it, and use it as a distribution, you have to take the penalty, as I mentioned. So, kind of looking at things for more of what's the best business case for a value add play, looking for properties that, have significant amounts of deferred maintenance that are doable, it's not a completely run down property. It's not something that it's a gigantic haul that's really going to take a lot of work, but it's something that, you've seen the operator do time and time again before you've invested with them. And it's something they can replicate on this property where they can, market rates or rents are below market rent. Appliances are old and you just need to switch in new, more efficient appliances, things that are going to be more attractive to tenants, and just repositioning that asset from one place to another because you want to deliver a greater yield to your retirement account. And then the other set of investors I see are people who are retired over 59 and a half and can see, they can take distributions from the account. And so I see some of those investors moving more towards, deals that'll cash flow a little earlier because that can help supplement their expenses day to day.
Mm-hmm. Mm-hmm. So what did you ended up falling into the first category.
Yeah.
Right. So what type of assets did you end up going after and getting at that point? What scale and size and whatnot?
Yeah. So let's see, the first one we went into for LPs with a retirement account it was a deal in Memphis, and it was 568 units.
Wow.
And yeah, it's a big one.
That
And
is a big unit.
and
Big
it gets better. The complex was, I believe, 44% occupied.
Oh, wow.
It was completely deserted. Essentially, the operator, they were one of the largest national operators in the country. And then, a year prior to the sale, one day out of the blue, they decided they were going to property manage themselves, across their entire portfolio.
Wow.
So they thought they could just take care of it and not have to worry about the 3-4% they were paying out to the PM. Obviously, that didn't go well. And so they started to, sell these properties that they really weren't taking a good look at and taking care of. This was one of them, and it just essentially they weren't even leasing it up. Everything was just totally deferred for the last 2 to 4 years. And so they ended up putting in, I believe, $21,000 per door into the property. It had phenomenal bones. It was only from the late 80s. It was a beautiful wooded environment with some nice expansive parking lots and space for community amenities. And so it really had the potential for repositioning it from really what ended up being a C- property into a C+ or a B-, something that tenants can actually be proud to come back to, as opposed to be worried in the parking lot if there was going to be some sort of assault or something, which was an issue with the property in the past. And so it was a great opportunity for us to help utilize our retirement dollars to better the community. And to find a property that just was going to, I haven't seen cash flow from it yet, but we know that the property is doing well because they're keeping reserves on property, making sure that the crime's down, and the unit turns have already completed at this point. So we're clear sailing from here.
And why aren't you seeing cash flow from it yet? It's just the way you had things set up with your LPs, or?
Yeah, it was. Well, so this was a deal that I was an LP on. It wasn't something that I general partnered on. But it was just the funny timing. We weren't supposed to see distributions for the first year, and that was perfectly normal. And then within that first year, at the very end of the first year, COVID hit. Yeah. And so they're now keeping more reserves on property just to make sure that everything is safe. We probably could have seen some distributions by now, but they're just being sure. And then it slowed down the unit turns just a tad. So, just small operational issues that we've all seen last year, but nothing huge.
Yeah, that is a heavy lift of a project right there. $20,000+ a unit, 40%, 44% occupancy on 500 and how many? 520?
68.
568 units. Wow.
They had 2 teams actually living on property to do the unit turns. So they would fix a unit, sleep in it. I think they finished 1 or 2 a day for the better part of a year.
Wow. That's a heavy lift, and that's a big project. Exciting to be a part of, I'm sure. How did you go about vetting your the operational partner, the general partner, the syndicator that you ended up partnering with?
Yeah, it was a little easier for myself just because they were people that I was partnering on deals with at the same time, and so there were folks that I had met in person and really gotten a feel for their ability to not just close on a deal, but really execute. The person who was asset managing on it they had an entire company surrounding asset management. That was their expertise. That was their bread and butter. They knew how to execute really efficient project management, great turns on units and keep the PM honest. So it was kind of one of those situations where I wasn't worried about the operator. I needed to make sure that the potential for the property was more there than anything else. Luckily, it was in Memphis, and I happened to have some family there, so I was able to check out the property just prior to purchase and kind of walk the grounds and see what it could turn into. And I've since returned and seen it, and it's everything we hoped for and more.
That's great. That's great. Congratulations.
Thanks.
All right, so let's talk about. Let's say I'm somebody. I've got an IRA right now, traditional IRA. I've got $250,000 in it, and I'm tired of the stock market. It's volatile. Crypto is still too weird and I don't quite understand it yet and all that good stuff. Like, who knows what the valuation of that is, it really is, and, et cetera, et cetera. But man, this apartment thing sounds really good. And there's a lot of smart people that are doing it, and people are getting great results out of it. How do I go about getting involved in an apartment investment with my traditional IRA?
Yeah, for, it's really not that much different than using cash. There's just some different rules you need to be aware of. But once you have everything set up, it's really pretty simple to operate with. You can invest in anything, as you mentioned, with your retirement account. And so I really liked. Sorry, I lost my train of thought. Tate, I'm sorry.
No, that's all right. So it happens to me all the time. So like I said, I've got a $250,000 in an IRA and I want to get it into apartment. What's the mechanics? How does that happen? How do I go about that?
Yeah, it's really not too complex. Getting it up and running. I like to say that there's really two flavors of types of accounts that you can actually operate with. There's the custodial account and the checkbook control account. And so most of our IRAs or 401ks are, they're held at large custodians like Fidelity, Schwab, Vanguard, TIAA, these kind of places that, their brokerage houses are centered around equities so that you can trade stocks, bonds, ETFs, mutual funds, things like that. It's pretty simple, but it's limited to that. And so you need to move the funds to a custodian that allows for these alternate assets, whether it's real estate or crypto, as you mentioned, gold, anything really that you're interested in investing in. And they can allow you to make use of your funds there. So you're going to move your funds from one custodian to another. And that's step one. In a custodian account, you can leave it there. If you want to leave the funds at the custodial account, every time you transact, you'll need to send in paperwork regarding, the general guidelines of the interaction or the transaction. Sorry, essentially spelling out who's in charge of the deal, what the deal is, your level of involvement, things of that nature. And this can either take a couple days if it's a good custodian, but I have seen some custodians take quite some time to actually execute this paperwork, just because they're overwhelmed and the people processing it don't have the time. And so I tend to I like to operate with a checkbook control account. And this actually takes it a step further than this. Once you have established the custodian account, at the same time, the vendor or the custodian, whoever is helping you set up that account, is going to open up an LLC as well in the name of the IRA. So 100% of the funds are going to be invested into that IRA into that LLC. And then the LLC is something that you can operate just as you would any other business. You can open up a banking account just as you would for any business. And you can essentially wheel and deal using just wires. You don't have to vet the deal, you don't have to send the information over to the custodian to vet the deal. I like to joke you can find a deal at breakfast and fund it by lunch. You should probably spend more time vetting a deal than that, but it's really that simple. And so the nice thing with that is instead of having to pay based off of the total value, like at a custodian, you would end up paying the total fees based off the total value of the assets held. So if you have a $250,000 balance, you're paying fees off of $250,000. And if you are a good investor and you start to increase the value of that account, you're going to start seeing your fees creeping up. With a checkbook control account, it's just an administrative overhead, fee. So you're looking at like $150 a year, roughly, just kind of for, making sure that the account is up to date and administrative stuff is taken care of. So between wire fees and the annual administrative fee, it stays pretty cheap. It doesn't matter how many times you transact, and it's been nice and efficient.
So is the checkbook control, that concept, is that the self-direction and the self-directed IRA, would you say, essentially?
They're both considered self-directed IRAs.
Okay.
Personally, I think that the checkbook control is a lot more self-directed.
Sure.
It's because you're in total control of it. You need to be aware of the rules surrounding everything because no one's holding your hand. But it allows you to really take full control of your account.
Yeah. Okay. And then from my limited knowledge on this in this area, I do know of the taxation that happens with self-directed IRAs in particular. It's called a UBIT tax. You want to go ahead and just take over here. I could kind of hack my way through what I think UBIT stands for, but I'm going to let you. It's something unrelated business income tax.
You got it. That's it.
Okay, good. Wow.
Yeah.
My own podcast, I got something right. So yeah, can you kind of walk us through how that works and what there is to do about it?
Yeah, absolutely. It's really not that complex. Let's say we're buying an apartment building, and this occurs when you're leveraging funds, which we do in multifamily, obviously. So say we're buying an apartment complex. We're going to be using 75% leverage, so 25% equity, 75% leverage. So you're investing, let's say, with $100,000 with your retirement account. 25% of all income that is earned by the equity that you brought in. It's earned by tax deferred dollars. And so you never pay any taxes on that because, the IRA was set up to help you earn money however you want. The leverage portion, because you're bringing in outside funds from a lender or an outside bank or something like that, who is utilizing non-tax deferred dollars. So your tax deferred dollars are now benefiting from the use of non-tax deferred dollars. And the IRS is okay with this. They say you just have to pay taxes on the portion that is leveraged and is earned by non-tax deferred dollars. So for 75% leverage deal, for the first year, you're going to be paying taxes on 75% of the income that comes in. And the income that you end up earning is called unrelated debt financed income, UDFI. And then you end up paying unrelated business income tax, UBIT. And so this is, a lot of people get scared about this because they're worried that they have to pay taxes within their retirement account. The nice thing is you actually, the leveraged share can actually use its, leverage portion of losses like depreciation, operating and interest expenses. So any kind of losses, they can use their share of things. So it really helps to offset things pretty significantly and help to mitigate the overall impact of UBIT.
Okay, so walk me back through, how does that work? What exact, how do I mitigate the impact of UBIT?
Because you can make use of losses, you're looking for properties that are going to be, you want to make sure you have properties that will do one of two things. You want to have properties that will have greater expenses. So, greater number of CapEx expenses, something that is going to, it lends itself to a heavier lift. But you also want something that is lower on the leverage side of things. The closer I see deals going towards 80% leverage, the higher I see, the tax penalty, but the closer to 70, 65%, whatever it might be, the better the tax situation. But then also, we also see that the majority of UBIT is paid not just on cash flow, because you have those losses, they roll over. So they tend to offset the first 3 to 4 years where you're paying $0, maybe a couple $100 in taxes. It's really on a capital gains event, something where there's a sale or a refinance above, your original invested capital amount. And that's where we see the large UBIT penalty. And so we're looking for deals sometimes where there's actually going to be a refinance in years, 2, 3, 4, something like that, where you can return, let's say, half of the funds to an investor. And with that, that's not a capital event. And so we're looking to return the funds to investors before there's ever, a taxable event, so they can go out and invest before they ever have to pay those taxes.
Got it. I think I got it. That's a new one for me too. And then you throw in the losses from cost segregation studies and how that can offset the income profit that you're getting off of the asset as well. Then at that point, you're doing pretty well.
Yeah. The nice thing is you can use cost segregation. That's still, so a retirement account can't make use of, bonus depreciation. It has to use only straight line depreciation. But the nice thing is cost segregation is a form of straight line depreciation, just in shorter straight lines.
Right. Shorter straight lines. That's well said. Awesome. So, okay. So, what typically are people that, what are the typical concerns and questions that people have that are looking at utilizing you and looking at Wall to Main as a company to work with?
The main concerns center around that taxation. It's kind of it's sort of the boogeyman that hovers over this entire space, and it's the reason I got involved. I ended up, for my own purposes, before I ever built Wall to Main, and now I use it in my operation, I built a UBIT calculator. And so it's the industry's first, and allows me to see for any given deal, I can take the projected earnings and I can turn them into projected taxes and see really, how impactful that's going to be on the bottom line for my investors. And so I'm able to go out and look for properties that, we can put together terms for a deal that work best for retirement investors. So it's mitigating those taxes, and then also just understanding the basics of how to operate with the account, how to establish it. And once it's established, it's pretty simple. And so it's really holding folks' hands from the start until they can wire out the funds and get the deal going. And then just making sure that we're properly communicating from there, because at that point they have it, on their own.
Mm-hmm. Mm-hmm. So your UBIT calculator, is that something that is available?
I wish it was. I've been trying to figure out how to make it available, but it's currently this ugly spreadsheet in my computer. It's 58 variables I have to input every single time, and it's just too bulky and cumbersome. So it's something that I that easily usable from other folks' standpoint, unfortunately.
All right. So listeners, lesson there is, if you've got a UBIT question, get in touch with Josh, because he'll pull out his calculator and he'll help you through it. Right, Josh?
Yeah, we'll be more than happy to.
Perfect. So on that, real quick, we'll touch on this again before the end, but what's the best way for listeners to reach you?
Yeah, the folks can find me on wall2main.com. And as I mentioned there, I have a ton of education surrounding the topic, not just on passively investing, but doing so with your retirement accounts. I also offer a free PDF called the Top 10 Tips and Tricks when passively investing in multifamily with your retirement account. And in that, I essentially share all the ways that you can best utilize your retirement account, ways you can either avoid UBIT or minimize it entirely and just maximize the potential you already have.
Mm-hmm. Great. So in your world, why multifamily? Like, why, out of all the different places that people can self-direct their capital to in their retirement accounts, why apartment buildings in your eyes?
I think there's really two different reasons. The main one centers around stability, and it kind of stems from a conversation I had with my dad. My dad is 62, and he is kind of gearing up for retirement. And so we need to figure out how to stabilize his account balance and make sure that it's there for him when he retires. Things are really, they're volatile right now. And so I ended up taking a look at, comparing multifamily versus the S&P 500 from 1990 until 2020, over the last 30 years. And I wanted to make sure that it was something that, if my dad invested in, his account balance would be there for him when he needs to, withdraw funds. It ended up being that multifamily was 58% less volatile than the stock market. It's even more stable than long-term U.S. Treasury bonds. And so you don't see these wild fluctuations. I'll be honest, my retirement accounts didn't do as well as my stock investments last year. It was just one of those years where you saw a massive, a fluctuation going up, and then, but you're not going to see those ups and downs with investing in multifamily. And that's why I think it fits really well for your retirement account, because if there is an emergency and you need to tap into those funds you didn't think you were going to be, or if you plan on retiring and you don't know when you'll retire, but all of a sudden you are, and you need those funds, you want to make sure that they're there and you're not withdrawing in the middle of a recession. So it fits very nicely. The other main one just kind of centers around, you can't actively invest in any deal with your retirement account. And what I mean by that is, if you are using a retirement account, you can't actively be involved. So you can't benefit from the action that your retirement account is taking, and your retirement account can't take any benefit from the action that you're taking. So that means that I can't invest in my own deals with my retirement account. I have to take my retirement account and put it in your deal, someone else's deal, whoever it might be. And so it needs to be purely passive income. No active income is allowed. And that's why I think multifamily fits very nicely, because as an LP, all you're earning is, rental income and capital gains, and those are both passive. So they fit, nicely with the requirements of a retirement account.
Mm-hmm. Yeah. Those are, that's a great take on why multifamily from a different angle than we typically look at it from. Although the volatility issue is one that we talk about quite a bit. There's a metric called the Sharpe ratio, with a E at the end, Sharpe with an E at the end, that measures the volatility of different asset classes. And commercial multifamily real estate is at the very low end of the Sharpe index, and it's a very low volatility proposition. There's a universal demand for housing, particularly workforce income level housing. The $500 to $900 a month level, rent level, depending on what market that you're in. Even in a recession, right? There's a reason, right, why we call this a recession resistant asset. In a recession, people downgrade from class A, class B, they lose their houses possibly, or they have to sell their houses, and they need a place to live. And so a lot of times most of the time, the demand for class C, class B minus, class C plus housing goes up in a recession. And so that's one of the things that keeps volatility so low, is that there's not a reactivity in the multifamily sector to overall economic shifts. That's really anything like, say, the single family market, for instance. In the last recession, there was about an 8% default rate in the single family world, and the multifamily world, if I'm not mistaken, was about 0.8%. So literally, a fraction of 10% of the foreclosures in the last recession in the multifamily world. So there's so many pluses. You talk about cost segregation studies and bonus depreciation and the write-offs from that, and the ability to leverage the hard work and honest efforts of a good business plan and a good team. Like being able to handpick who you want to work with, who you want to carry the ball for you. That's massive. That's self-direction right there.
Yeah, I love it. I think one of my favorite aspects is you're investing in real estate theoretically, but with multifamily, you're not just investing in real estate. You're really investing in a business, and you can pick the partners you want to work with, pick the business plan, and the folks that can execute it the best. There are real estate benefits from that, but you essentially get to pick the business you want to run and be invested in.
Yeah. Yeah. Well said. Well said. Well, for someone that's never looked at this before from this perspective, and is considering, like, wow, this is something I could do. This is, I've got this chunk of money right here that's doing nothing or next to nothing, or isn't doing what I'd like it to be doing. I mean, what do you have to say to those folks at this point?
To me, from my perspective, I was in the same place at a certain point 3 or 4 years ago. It seemed intimidating, and I also didn't know exactly how to start. I will say, once you have the understanding and the education under your feet, it's like riding a bike. It's there in your mind. It's really no different than operating with cash. You understand, the few rules you need to work around, and you understand how to deploy your funds and vet the deals that are best aligned for your retirement account. So once you have it in your mind, I set up 6 videos that are 30 minutes total. I view that as the total amount that you need to understand if you're using a retirement account in multifamily. The education you need is a small finite amount to get there, and once you do, you're good to go.
Awesome. Hey, I'm just checking your website out, bud. You've got your UBIT calculator on your website.
Yeah, I run through a YouTube video.
Like on
YouTube. I have a little video of how it works and what we look for. Yeah,
that's exciting. Cool. Well, I encourage you listeners to go check out wall2main.com. It's a very resourceful website that Josh has put together. And you can reach Josh there. learn about his portfolio, check out his blog, and learn all about him. So I would really encourage listeners to go check that out right now. If you're not driving, go check out Wall to Main so that you can learn more about investing with SD IRAs, self-directed IRAs, and about UBIT and all the things, all the ins and outs. It's really a mindset game in this space, really across the board. And the more that you know, the more specialized knowledge that you have, the more confidence that you have in your ability to conceptualize some of this stuff and talk to people about some of this stuff. So I know without a doubt, now that you and I have had this conversation today, that somebody's going to come to me in the next week and they're going to have self-directed IRA they need to invest in. And I'll certainly know where to direct them for some advice. So, hey, Josh, you've got a really beautiful picture of you taking a picture in front of a mountain.
Yeah.
On your website. Where is that? I'm just curious. I'm a mountain guy.
That is in Indian Peaks Wilderness outside of Boulder, Colorado.
Oh, it's beautiful. Yeah. Okay.
I wanted a nice backdrop for my videos. So.
Yeah, it's a great one. Yeah, we're in Salt Lake City, so we get some nice backdrops here too. If you're on video, you can see the one behind me right now.
Yeah.
So, well, great, Josh. This has been fantastic. Any final words of wisdom to offer listeners?
It as we've been mentioning, it's really the education piece. Regardless if you're interested in doing retirement accounts or anything else, having that you put it so well, having that specialized knowledge gives you confidence to operate within your wheelhouse and know where you need to go from there.
Yeah, exactly. The more you know, the more you can thrive, the more you can speak the language, the more you understand. Like life is, one of my favorite coaches back in 2007 said, Tate, life is a linguistic phenomenon. And I think that's really true. Like the reality of our lives happen within the realm of language, and what we can understand and conceptualize in language and therefore teach and help other people understand is really where the rubber meets the road. It's really where, the richness of life is, in my opinion. And so I think you're doing, you found a really cool little niche here, Josh. And I know that you're an educator and a giver. I've heard you on other people's podcasts, and I'm sure your future is just extremely bright at the ripe old age of 30.
Thank you. I really appreciate that.
Yeah, I've got a few years on you, like more than a few, but that's all right. I get to learn from so many different types of people, different ages and levels of expertise on here. And it's a true honor. It's been a great time having you here. Appreciate it.
Yeah. Thanks for having me.
Yeah, you bet. And listeners, again, walltomain.com is where you can find Josh. And we will check you next week on another episode of The Apartment Guys. And until then, keep doing big things and keep crushing it. Take care, everybody.
Thanks for listening to The Apartment Guys with Tate Seamer. Tate and friends are grateful to have you as a loyal listener. If you like what you've heard, please subscribe, rate, review, and share with friends on your Apple Podcasts, Google Play, Spotify, or any other podcast platform. Also, check out Tate's YouTube channel for videos of many of these episodes and more. Until next time, take massive action steps and rock on.